So what would the IRS see from this is our, like I said, remember, this is what we can see. The IRS would see this, just your corporation, because they would be looking for a tax return, and your individual tax return in that scenario. So one more time for those of you at home who are maybe taking notes or screen pictures here. So we've got all these. So that's two rental properties, and it looks like a corporation with a flip going on someplace, doesn't matter where in this scenario. Our holding company and our living trust, the only tax returns that show up, corporation and individual returns in that scenario. Okay. Now, if you've got unrelated parties involved and partners, you'll have some additional tax implications there. However, they're not all bad. Having a partnership at that holding company level or that blue box level can actually provide some additional lending benefits as well, which we can talk a little bit about here in a second. Okay. So that holding company, that blue box, can either be taxed as disregarded or ignored for tax purposes, and it'll just flow through to these individuals, flows through the trust. The trust doesn't have a tax return either. And then, like I said, corporation and individual tax return. In that other scenario back there, had quite a bit going on. Like I said, really important from this perspective, whether it's a C corporation that's doing an 1120 or an S corporation that's doing an 1120S. The IRS is very creative in that regard as well, as you can see. But ultimately, you want to have somebody run the analysis for you on which one is best.